All right, guys, in this video, we're going to look at the Bollinger Band trading strategy and how to use it to predict breakouts. So Bollinger Bands are a favorite trading indicator among professional traders. They were developed and made famous by legendary technical trader John Bollinger and are plotted 2 standard deviations away from a simple moving average. The usual moving average used is the 20-day. When market volatility increases, Bollinger Bands will widen and move further away from the average. Conversely, when volatility contracts, the bands will move closer together. Combining Bollinger Bands with a Bollinger Band width indicator can be an awesome early indicator of whether a stock is likely to increase or decrease in volatility going forward. Today, you're going to learn how to spot high probability setups using Bollinger Bands, including some real life examples. Before that, we'll just explain the Bollinger Bands in a bit more detail. They're price channels, with the upper band being 2 standard deviations above the middle line and the lower band being 2 standard deviations below the middle line. The middle line is typically a 20-day moving average. Traders can alter the standard parameters. For example, one trader suggests changing the standard deviation to 2.5 to give a more reliable signal. Having a stock touch one of the outer Bollinger Bands does not signal the end of a trend. In fact, it can sometimes mean the opposite. Looking at the chart below, you can see a number of times when price touched an outer band but continued in the same direction for a few more days. My favorite method for using Bollinger Bands is to determine whether a stock is likely to experience a range expansion or contraction in the weeks and months ahead. We can do this by looking at past behavior of the stock and adding an indicator to show the Bollinger Band width. So this is a great way to use Bollinger Bands when we're looking at trading iron condors. If we've gone through a real big period of expansion, we can look for a period of contraction to follow. We can see that here on the chart. Point 1, the Bollinger Bands get really, really wide, and then going forward, the stock trades in a more narrow range for a couple of months. Point 2, we've been trading in a really narrow range. The Bollinger Band width is really, really tight. Then we get a breakout. Then again, we get some wide Bollinger Bands, and then towards the end of the chart here, really, really tight Bollinger Bands. So again, ready for a breakout potentially. So based on that prior chart, I made a trade in FCX using Bollinger Bands and the principle of range expansion coming after a consolidation. At point 2, I decided to enter a long strangle with the assumption that FCX would likely break out of the 2-month range it had been stuck in. So let's just go back and have a look at that again. So really tight range for about 2 months. So at this point, point 2, around here, I entered a long volatility trade. The trade details were on July 7th. Bought a Jan 20th $10 put and a $12 call, so that's a strangle, which costs $3.12. When doing a strangle, I like to go out 6 months and set a time exit of 2 months. So if the trade is not working after 2 months, I can get out with minimal effect from time decay. By July 12th, so within only 5 days, the trade was looking very nice, with FCX having moved from $10.60 to $13. I closed the trade on July 20th when FCX was trading at around $12.20. So I didn't get the best exit. Would have been better to get out when it was at 13, but still managed to get out with a nice gain on the trade when FCX was trading at $12.20. So again, here's that chart and the profit at the time. So we got this big breakout here, and then I think I exited once we got a little bit of a pullback here. So it was a 13.78% profit in just a few days. So that one worked really nicely. The next trade example is using Bollinger Bands to predict when a stock might consolidate. From early June to early July, TLT moved from 129 to 143, a move of 10.85%, which is pretty big for a bond ETF. This thing doesn't tend to move around that much. During that time, the Bollinger Band width expanded massively from 3 to around 10. Once TLT pulled back to the middle of the bands, I figured it was due for a period of consolidation. So this time I entered a short strangle. So again, expecting a period of consolidation to follow a big period of expansion, we go short volatility. We trade a neutral, short vega, positive theta strangle. So trade details, July 20th, we sold the August 131 put and the 148 call. I kept the trade to only 1 month duration in order to make the most of time decay. Implied volatility on TLT was in the high area of the 12-month range. So again, that's another important factor, checking out implied volatility. Due to the high volatility, I was able to place the strikes well above and below the price of 139. In fact, I would have even done better. I would have had a better trade if I had brought the strikes in a little bit closer, been a bit more aggressive with the trade. So a month later, as we're heading into expiry, TLT still trading around 139, and the short strangle is going to expire worthless. You can see that the Bollinger Bands can be a great indicator to add into your trading arsenal. Combining the Bollinger Band width and an analysis of implied volatility can make a great foundation when looking to trade breakouts or consolidations. So here you can see that example, really huge run up from about 128 to 143. Bollinger Bands at 0.1 there, just the widest we've seen in quite a long time, well above where they were when they were 2. Width was 2, went to 10, pulled back into the middle of the Bollinger Bands, and then completely sideways for about 5 or 6 weeks. Maybe a bit less, maybe about 4 weeks. So that's how we use Bollinger Bands in our trading. Hope you enjoyed this video. Let me know in the comments below, and I look forward to hearing from you, and best of luck with your trading.